Okay, we are live, everybody. Thank you for joining. Something about going live. You just never feel quite ready for some reason. Leave in the comment section if you do a podcast or something like that. If you've done like an extended series, multiple years, let me know if that feeling ever went away for you. I always just... Let's turn myself off. I always feel like there's just this mad panic in the last 20 seconds or something, and I always feel like something's broken. So here we go. Anyway, we are live. I'll figure it out. I'll clear my brain in a few seconds. So thank you, everybody, for joining. I think this is episode 94. We are closing in on 100. And you could do me a big favor by, of course, subscribing and giving the video a like for me. So I know that's a little weird asking ahead of time, but at some point today, if I say something that you are interested in, make sure that you give the video a like. So looks like the comments are up already. You can go ahead and put your questions in the comments. I have a couple of topics that I would just rant over really quickly. A lot of the topics that I talk about, maybe not a lot, but let's say half, is I'll make a video and I feel like I'll explain things reasonably well. It's my video. Hopefully I'm happy with my own videos. And then, of course, I'll get a series of follow-up questions and I'll realize maybe I forgot something, maybe I didn't say things quite right. So both topics today are something that I'm just going to clean up a little bit of the things that I said and add a few more things. I think it'll be interesting, so bear with me. We'll do two quick topics, and then, of course, we will get to the questions. So I'm going to talk about short VXX performance. This is going to be a back test showing if you use the VIX index as your trade filter versus using my volatility barometer, which I hope to show everybody that it is significantly more robust than the rather garbage indicator that the VIX index is. I've always said that and proved it many, many times. And I just want people to get away from what is certainly the most recommended, the most covered, the most talked about indicator in the volatility space, the VIX. It is actually quite poor for trading and using as a filter. So we're going to go ahead and show that. And then, again, we're going to clean up a little bit of the things I said about the iron Condor fees. We covered that last week. Feel like it went pretty well. People got an understanding that, yes, fees are expensive, but it's part of trading. But there is one thing that I could probably add to that, and we're going to go ahead and do that. And then the Q&A, of course. Ask me anything. We've got trading, volatility, options, all the good stuff that we actually do. And then off topic if you feel like trying to just chat about other stuff, embarrass me about politics, all that stuff. So let's actually get right into this. So how I'm going to set this up. I don't know why I feel a little bit frantic right now. Didn't have a very good last, say, hour and a half. After the workout, I was late eating dinner. I was late doing this. I was late uploading the video. I was late uploading the thumbnail. Yeah, it was just felt like an hour behind the whole day. So one of those days. It's, 1 in the morning for me now. So if you're thinking, wow, this is actually just noon. No, I'm in Taiwan. It's 1 in the morning. But anyway, so let me first cover what the general volatility barometer is before I actually go through some numbers here. So for our community, I have created what I call the VTS Volatility Barometer. You can see it here. And essentially what this is a combination of all of the volatility metrics that I feel are the most important for trading, all combined into one single index. So I call it the Volatility Barometer. If I go down to our dashboard, let me see if I can look at that. That's much better. Blow it up. You can see it says all my top volatility metrics combined into a single index. So this is one single number, but of course you can look at it over rolling periods. So this is just the past 1 year. You can see it's pretty elevated right now. The last 3 years, and then this is since inception. And the only reason inception is 2011 is because one of the metrics within my barometer was only available in 2006. All right, the volatility space is relatively new as far as data goes, and I need about 5 years of it churning through the percentiles before those numbers become robust enough to actually use. So 2006 is when the data is available. 2011, I can start using it for trading. And, you might think, oh, it's been around for 20 years. That's a long data set. You got to remember that 20 years in the grand scheme of things isn't actually that long. So that's why it's 2011. But the volatility barometer is how I basically cycle through some of my trading strategies. So as you can see up top, today it's at 67. What this means is based on all of the metrics that I feel are the most important, 67% of all trading days going back to January 2006 were lower volatility than today, and 33% higher volatility than today. So we're kind of in that safety range, you would say, top 2/3, so to speak. And then, of course, our strategies reflect that with the tactical vol being in gold, performing very well the last, month and longer. And then defensive rotation. This strategy has been our best for the last 4 or 5 years. And right now it's in utilities, so it's also in safety. And then strategic tail risk is also in IYR real estate, which is a sort of a half safety position. It's the most correlated to stocks out of the 3 safeties, but it is still what we consider our safety position. So that's the volatility barometer. Now, what I did in that video, and you can actually see it if you want to watch it. Not a whole lot of people have seen it so far. It's this one here, volatility barometer. It's got this picture of the barometer with the, big red bold market crash. Get a little extra views there. Sorry about the clickbait. But essentially, I went through a back test where I'm going to be using the barometer to short the VXX, so the long volatility ETF, VXX, ETN specifically, and we're going to use the best 50th percentile of signals. That's it. Just a dirt simple in or out, short VXX or cash, 50th percentile, so half the trades. Our benchmark is the S&P 500. So this is the S&P 500 since my volatility barometer launched in 2011. Now, long term, it's actually about 9% with a 56% drawdown. But in the last 12-year mostly bull market, it's 12.6. So this is what everybody's trying to beat. Now, if we go over here, this is using the VIX index. All I did was take the lowest percentiles, and this is a full walk forward. This isn't a look back bias test. This is a walk forward, but 49.99%. That's how many trades it's going to be short the VXX. And then the other ones are going to be in cash. So this is actually the results using the VIX. You can see how terrible it is. The VIX right here is in red. The VIX produced a 3.7% rate of return with a 61% drawdown. So you can see the VIX is really poor at identifying the good times to be short volatility. Right? It's a volatility index. However, what is the VIX? The VIX essentially is a representation. It is just a statistic. It's not a tradable index. It is derived based off S&P 500 options activity. Now, that in itself is not it's a fairly specific aspect of the market. And option trading specifically on the SPX, this isn't necessarily going to be correlated to getting good trade signals, because a lot of that might be hedging, a lot of that might be speculation, a lot of that is just people not really knowing what they're doing. So it's actually a metric that, while it's derived correctly and the formula is correct and you can go look at it and it seems pretty useful, it's actually not a very good place to get signals from, because A, it doesn't cover very much of the market, but it's also specific to option trading, which might not necessarily represent people's true trading bias. So you can see it here in the test. The VIX does a terrible job. So anybody using the VIX index for trading, it's pretty hit and miss, as you can see. Sometimes it works brilliantly. This is 2017, that really good period there. But I mean, let's be honest, that was largely just because that was the lowest volatility period, certainly going back to the 60s, but possibly in history. So sure, short vol absolutely crushed it for a year. But is that because of the VIX? Because the rest of the time, the VIX is really hit and miss. And so now I did the exact same test with my volatility barometer. Again, the same 49.99% of days. And again, this is 2006, walking forward to 2011 when it becomes useful for trading. And you can see my results in green, just a straight dirt simple 50-50 in and out. It's now up to 29% annual return with a drawdown of 34%. So same drawdown as the stock market with roughly 2.5 times the performance with a better indicator. Again, if you're using things that I tend to look at, which is a broad view of the market, we've got VIX futures, we've got the cash VIX term structure, we've got S&P 500's, volatility risk premium, we've got all these different metrics plus more that I don't find very useful to share with people because they would never use them anyway. But the ones that I share, I feel like people can understand and use themselves. But that's what the volatility barometer can do for people, is obviously much better performance. So that was all covered in the video. And then the typical question that I got in response was, well, you're using the VIX wrong. People would say, no, that's not actually how you use the VIX. You're supposed to actually short VXX when the VIX is in the highest 50 percentile. The lowest is when it's already come back down. People tell me that I'm using it wrong. Now, it actually came up like 5 or 6 times. This wasn't just one person. Probably about 10, to be honest. But it just seems intuitive that if the VIX was positive but only positive 3%, the inverse isn't going to be very good either. But I do like to be thorough, and I ran the numbers just to do a little add-on. I didn't do this in the video, but I could have. You can't edit old YouTube videos, unfortunately. But if people want to see what happens when you actually just flip it, and now I'm shorting the VXX just on the highest 50th percentile of VIX values and being in cash on the low end, I don't think it should surprise too many people that this is really terrible, right? The VIX getting signals during low volatility, which if you are an experienced volatility trader, you'll know that the best times to short volatility is when the market is stable. So that's why I say the lowest 50% of VIX readings is supposed to be the best readings. And as the results showed, it was positive 3.7% with a 61% drawdown. So a terrible indicator. But the inverse is substantially worse, of course. Now you're talking about a 94% drawdown with minus 15% per year, like annual return. So this is no good at all. But what's maybe even more interesting, at least for me, to just proof of concept of the volatility barometer, what happens if we use my barometer and we flip it and we actually short vol when the barometer is above the 50th percentile and it's in cash below? Well, now we're talking about something that is, you could say, extremely consistent, but of course, very consistent to the low side. So I view this as a definite proof of concept that it is doing its job, because if you inverse it and it's this diabolically bad, that means that the inverse of that is actually significantly good, right? So I am using these metrics correctly. Of course, I knew that, but I do like to show people the numbers. And head to head here, you can see that my barometer, when inversed, is way worse than the VIX index, which is what I would expect to happen if it was a better indicator. So again, this is the positive side. Going from 29 up to down 3, this is the negative side. So I don't think there's really any doubt that what I'm doing, I have had, and I don't take criticism like, oh, I'm trying to prove a point, but I've had people say, well, all your volatility barometer is just mirroring the VIX index. That is, quite obviously not true. The performance is extremely far apart from the VIX itself. Now, the last thing I will add, trying to get a little bit looking forward here of questions that I'm anticipating people. I don't want to come back next week and have to talk about it a third time. So how many of you in the chat section are thinking to yourself, okay, you've proved that the upper half sucks, but that's still not how you're supposed to use the VIX. You're supposed to wait until it gets to really extreme readings, maybe the top 20%. And that's when you're supposed to strike with the short vol. Really play that contrarian, right? Is anybody, let me know in the chat, is anybody thinking that right now, that 50% is too large a band? He should have actually only used the top little bit. Do you want to see it? I did that. I ran those numbers too. So let's take a look at what that is, just so nobody emails me tonight and says you did it wrong again. So this is what that looks like when you short the VXX when the VIX is in the upper 80 to 100th percentile. Again, the results are actually even worse than using the entire data set. Remember, it was 3.7 with 61% drawdown. Now it's pretty awful, right? And the reason that people don't understand this is recency bias, because what they'll do is say, oh no, that's not true at all. The best entry possible was during COVID, when you wait for the VIX to get to really high levels and then you short volatility. There's a couple problems with that thinking. First of all, recency bias. I mean, you obviously you want to look at what the market has done for 20 years, not just one single instance when the Fed threw $7 trillion at the market. I mean, that's kind of skewed. But also, that's only one incident. So as investors, we can't invest based on what happened once in 20 years. You're just not going to get enough occurrences. Even if you catch it right, it's still not going to produce the type of portfolio return. You'd be far better off making a very low, consistent return for 20 years than making one really good return for a 2-month period, right? So you never want to design strategies that you get 2 occurrences per decade. It's really kind of a non-starter. You want to throw some extra money at it, that's fine, but that's not how you design strategies. But the reason that it's actually happening is because those high-level signals, that is the exact time when you would not want to be short volatility. Now, it is true that if you were to do that consistently, occasionally you will play that contrarian perfectly. You will jump in and the market will bounce back and recover, and you'll participate in that. But there will also be times when the VIX is very high, you wait for it to get to 30 or 40, and it's just on its way to 80, right? That happens as well. And that's why there's so much drag here, is that it's extremely hit and miss. And if you do that, a lot of times you are just, as they say, catching the falling knife. So it hit and miss, but obviously not something that I would do. Why wouldn't you just use a robust metric and just get consistency over 20 years, right? I think that we can all agree that's probably what we're going to be doing. So did I get it? Did I cover everything? Or you want to fire some comments really quick, ask some follow-up questions while I'm still here? Probably won't circle back and do this topic next week, but hopefully that is covered. Now, the other thing that I want to talk about really quick, there are some questions in there, so we'll get to those soon. But it's with iron condor trade fees. Now, what I will say is just right off the bat, obviously iron condors are an expensive option to trade. An iron condor is a 4-leg option. So trade fees are part of the game. We just have to pay them. But when you're trading 4 legs of an iron condor, of course it is, you could say, the most expensive option spread. Now, the benefit to the iron condor is it's a very high probability trade, so that's the trade-off. It's expensive to open, but you'll get a lot more winners than losers, and in the end, it is still well worth trading the strategy. But I do want to talk about it because last week's live stream, I showed there's 3 ways to reduce the trade fees. If you really got it in your head that I just don't want to pay these fees, then there are 3 ways to do it. The first layer is what we do with VTS, and I'll show you our current trade. It's pretty simple. We use the ETF, and currently we have a trade on the Qs. So this is easy to look at. There's the trade right there. And we do a $5 strike gap. You can see the difference between 440, 445, 540, 545. It's $5. So that's as close as you can get. They don't do $1 increments on the Qs. So that's step 1 from my email. If somebody wanted to reduce the trade fees, they could expand this strike gap. So you could do the 440, 450 and the 540, 550. Expanding it, doubling the strike gap, you will essentially cut your fees in half. But there's also something else you can do, which is you can trade the index. So the index would be a cash-settled index. For the SPY ETF, you'd use the SPX. For the Qs, like our trade is open, you'd use NDX. And for IWM, which we sometimes use as well, the Russell 2000, you have the RUT, the RUT. Those are the 3 main indexes that if you really had a big account, you could trade the indexes. But that's what I want to talk about because I've been kind of in a behind-the-scenes conversation with somebody, and there does seem to be some confusion that risk factors might not be the same. So what I want to show is a test. Oh, wait, wrong spreadsheet. Just give me like 20 seconds to open the correct spreadsheet here. And I don't know how quick this will be. Maybe not 20. You know my spreadsheets, they're way too long. They crash my computer. I've had nothing but problems with spreadsheets. Over the years, I've lost so many. Just they don't open anymore. They freeze and beach ball my MacBook. So far, so good. Give me 10 more seconds. But what I'm going to do is I'm going to show what would happen if instead of the Qs, a person actually did do the NDX. And let's just talk about whether saving that money on trade fees is actually a good idea or not. It's beach balling for me. I don't know if you can see that. Okay, so what we've got here, this is the trade that I actually opened. But this back test, I'm using closing prices. For my trading in my portfolio, I always report performance based on my live fill prices. I'll show you the live fill prices later. They're not quite this. I actually got 126 and I closed mine for 119, but end of day it was 104. So we're going to use end of day for both of these. 125 open per contract on the Qs. I should actually make that clear. This is the Qs. Per contract, it's only 375. So anybody pretty much can follow this strategy. You can get 2 contracts if you have a $25,000 account. So technically you could do this if you only had 12,500, you could still follow VTS in all the correct allocations. Some people ask me this, what's the minimum capital required? Well, 12,500 means you can trade it in all the correct allocations. But if you had less than that, if you had 5 or 10,000, you could maybe instead of 5 strategies, you could drop it down to 3 and you could trade it on an even smaller account. But point being, you can trade it on 12,500, but we're doing 25 here. So this person, 3% allocation is what we use per Iron Condor of the entire trading account, and they opened 2 contracts. So the profit, and they made $44. This is a trade that we opened, we left it open for a while. It didn't do a whole lot. It got inside 30 days, so it's time to close it. I don't like getting my trades too close to expiration, so we just opened and closed it basically for a similar price. Wasn't a big winner, just a small winner. $44. Trade fees are $10. This is the part that people don't like because when you think about an Iron Condor, it is 4 legs of a trade. That person opened 2 contracts. That's 8. And we close every Iron Condor as well. So it's 16. Now, right now at Schwab, TOS, 65 cents per contract. That means you're paying $10 to open 2 contracts of that Iron Condor, and the trade only made $44. So that seems like it's a very big hurdle, and that would suck, right? Now, that's because the trade was actually just a kind of a net zero trade. But anyway, the percent of fees as to the allocation is 750. So I'm going to show you 2 things that people need to be aware of. One, even if you have a large account size, and even though you're trading a lot of contracts, if you have a lot of money, it's still the exact same impact of fees. So if you've got this person, first of all, who has now a $250,000 account size, they open at the same price, capital per contract, it's still on the Qs, they just have 10 times as much money. Their allocation is 10 times, the contracts are 10 times, everything is just 10 times. Profit is bigger, trade fees are way bigger, 10 times bigger. But you will notice, of course, that relatively speaking, they're both still paying 1.39% based on the allocation size. Nothing has changed. The difference between 2 contracts and 20, yes, the nominal value of fees is going to be higher, but the relative impact on a portfolio is exactly the same. Like I said, there are only 2 ways that you can actually reduce this number. The first way would be to widen the strike gap. So like I said, instead of doing the 5, you could do 10. Now, one thing I want to make clear, you have to try to follow the logic of how options work. Yes, it's true, you're cutting your fees in half if you do that. But I'm not telling you not to do that, but just be aware that that trade with a $10 strike gap is slightly more risky than the one with $5. The reason for that, if you imagine the short strikes are here, if the long strikes are very close to the shorts, that basically makes the vega quite low. So when you get a losing trade that's going against you, a short vega Iron Condor going against you in a fast-moving market, you want those strike gaps narrow so you can reduce that. It makes it a slower moving trade, and maybe you can stop loss out at a reasonable number. Right? You get into a situation where maybe you're down 30 or 40%, your stop loss is 50. If the market tanks, it could go right past the 50 and it could get to 60 or 70. If you widen the strike gap, the wider it gets, the more exposed you are to that move, and you're going to lose even more money. Now, obviously, this isn't going to happen every time. Maybe, you'll get 7 trades in a row where it's basically a wash. It's the same profit and loss, and you saved half the money on trade fees, so great, it seems worth it. And then you're going to occasionally, 1 in 8 trades, you're going to get that one that moves too far, and you're going to pay all those fees back. So I'm not saying you shouldn't do this. I'm just saying that they're not identical trades. It's not like choose this for this rate of return or this for the same rate of return and save fees. In that case, obviously save the fees. It would be the same as saying, well, if you've got this broker that charges you $1 and this one that charges you 65 cents, it's the same strategy. It's the same trade. Choose the cheaper broker, right? Obviously. But don't adjust your actual trade strategy to save the trade fees because you are increasing the risk. And long periods of time, which I'll get into in a second with a little story about my spreadsheet, is it's just not going to save the money that you think it's going to save. But the second thing that you can do, and this is where things get really interesting, is what if you did on the exact same day trade the index instead? So now we're talking about a situation. How do I unhide this? That's not the one. Unhide this one. What? What is going on? My spreadsheet is beach balling here. Oh no. Something is really wrong here. Okay, sorry. Beach balling spreadsheets. I hate that. So now we're going to do a person who did the NDX. And this is going to be for all those people who think, well, I've got a really big account size. I'm actually going to try to reduce my trade fees. So open for 27.30. Now you can see that per contract, one contract requires $7,270. So if you have a $250,000 account and you trade a 3% allocation, which is what we do, right? 3% of total net liquidation value, you need $250,000 account size to trade one single iron condor. Now, that's obviously going to create a massive inefficiency because in order to get your second contract, you have to have an account size of $500,000. Might take you a while to go from 250 to 500. And that entire time, you're not going to get that efficiency of capital where you're actually hitting our numbers, right? How are you going to hit this allocation if it's literally a $250,000 portfolio jump just to get one additional contract? So that is obviously a major problem. You would need a significantly large trading account to do this. But the point I wanted to make is the fees are cheaper. You can see that it says trade fees here. God, this is frustrating. I don't think you can see that, but for me, it's just frozen up. Trade fees, $5. Now that looks like, oh, it's only half the price, but you got to remember that's on a massive account. These trade fees for the index is 0.07%. It's, a rounding error. It's basically free. So if you want to reduce your iron condor trade fees to almost zero, you use the indexes. But here's where I have to tell you that just experience-wise, I can possibly steer you away from this. So back in the day, I've been trading iron condors for like 15 years. But back in the day, many years ago, I didn't know the best system, right? I have come to the best system after live trading since, 2005 in total and roughly 2008 with iron condors. Took me, 15, 17 years to come up with the best system. But back then, I didn't know that, right? I did my back testing. I tried to figure out the best, but I didn't really know. So what I did at the time is every time I would open an iron condor trade, I'd actually open 3 of them. So let's say it's a SPY trade. I would open one on the SPY with a $5 strike gap. I would open one on the SPY. At the time, I would use a $15 strike gap so that I would actually see the results differently. I didn't just go to 10. And then the third one, I'd use the SPX and I'd actually do an index option. And not only that, but at the time I was also testing the correct stop loss level. So I used 50%, which is what I still use today. It turns out that is definitely the most efficient. But I also used 30% and I would track that whenever that trade would have closed out. I record it in a spreadsheet. And I also used 80%. So letting them go really, really far. So essentially, I have 9 different trades that I'm tracking each time I open an iron condor. And I did this for like 5 years. And unfortunately, that spreadsheet, it's not gone. I might actually be able to save it someday. But the second I touch it, it freezes the computer. I can't do it. Maybe I'll send it in to somebody and see if they can fix it. But it's unfortunate I can't just pull up the results. But generally speaking, it's pretty much what I just said. The difference between the strike gap widening turned out that roughly 6 or 7 trades, it was about the same. And then, like I said, occasionally you're going to get that one that ran 5%, 10% too far. So you end up paying all the trade fees back. And in the end, they were basically a wash. So I just thought, well, why not make it accessible to the most number of people and do a $5 strike gap? If you want to do 10 or 15, I think long run, it's going to work out the same. You're going to save half your money at least on fees, and then you're going to pay it back once every couple of months when a trade runs too far against you. Probably going to be a wash. But the interesting one, and I honestly cannot explain why this is, but the index options performed significantly worse. So the actual rate of return, even though the trade fees were 0, the rate of return of the index options, same day, same entry time, open and close, everything the same, 15 delta on both sides. Oh, that's another thing. I used to test the deltas, 10, 25. I used to have a whole spreadsheet, and then I'd basically have a supercharged data set over a 5-year period. I've got, 1,000 trades. And but anyway, the index options were the clear loser. And I don't know why. If anybody can explain, why they think index options don't perform quite as well. Remember, they're not mathematical inverses. They're not mirrors of the ETF. They are also freely traded in an option market. But actually, you can see that here today. This wouldn't happen every time. This is just one trade. But this is the NDX in the blue here. And you can see it entered at 27.30. The closing price was 27.95. This trade lost money. So the first trade actually made 0.5%. This index option on NDX, this is actually the numbers for that exact trade. Opened September 12th, closed yesterday. It lost money. Now the trade fees are free, but it lost money. And this is something that I just know to be true because I've tested it for many years in the past. I have the data showing index options don't make as much as the ETFs. I don't have a great explanation for why. But what ends up happening is even though it seems advantageous to save this money, you will be worse off. Now, this trade is probably an extreme aberration. If you had, say, 30 trades in a year and they lost 0.6% per trade, you're talking about 18% annual return worse with index options rather than this to save 1% on fees. It obviously doesn't make sense. Now, the real difference, it's not 18% a year. Like I said, in my live head-to-head testing over a 5-year period, it was about 3 to 4%. Don't know why. But again, I get back to the same point. I'm not telling you not to do this. I'm just saying that not everything is occurring in a vacuum. Whenever you change something, you have to understand that there might be a consequence. You might actually be raising the risk. So my general rule after this whole spiel, the takeaway here is that I never do anything in the trading strategy itself to save money on fees. I will only ever do something to save on fees at the 30,000 foot view level. So if you wanted to try to search out for a broker that charges less money for fees, I've heard things like TastyWorks. Obviously, I've used interactive brokers for 15 years. They're significantly cheaper than TOS. These days, not so much. They're all getting pretty competitive. But interactive brokers is lower. I've heard TastyWorks is lower. If you want to do it on the broker level, don't go to some crappy, cheap broker that has terrible service and stuff. But if it's just a major broker, the major 3 or 4, go ahead, go to the brokers. I like TOS because I'm on my computer 12 hours a day, and I just think IB is the ugliest software on planet Earth. So I just don't want to look at it. So IB, it's just worth the money. Just take an extra 10 cents per contract. It's fine. Just don't make me look at the IB software. But on the 30,000 foot level, yes, go ahead and do that. But don't ever adjust your strategy to try to save 1% on fees, because in the end, you're going to pay that back somewhere else anyway. The options market is largely efficient. The markets are largely efficient. There's nothing wrong with trying to reduce fees, but don't do it at the expense of the strategy. The rate of return of the strategy itself is primary. Everything else is just secondary little efficiency improvements here and there. It's kind of like taxes. I've said the same thing about taxes, actually. I love plugging my own stuff. Here we go. I have a video talking about short-term versus long-term capital gains tax. This video here, and welcome back, everybody. Oh, that's a huge echo. Oh, I remember this one. This was in Dubai. This was an Airbnb in Dubai. Huge echo. Big problem. I actually moved out of this house because of the echo in my videos. But anyway, in this video, I basically ran all the numbers in the video, and then the end conclusion is that for people who are doing a long-term buy and hold portfolio, all you have to do is increase your annual rate of return by about 1% or 2%, and active trading is better. It's better to better to pay short-term capital gains and make 2% more per year than it is to have totally efficient long-term capital gains, buy and hold, and only making the 7 or 8% that those, pie chart portfolios actually make people long-term. All you have to do is get an extra 2%, and you're better off paying short-term capital gains. It's the same concept there. Don't ever do anything that doesn't prioritize the rate of return itself. Taxes are secondary. Yes, in a vacuum, if you have a situation where the exact same rate of return would produce two different tax rates, choose the lower tax rate, obviously. But if you're in a situation where you're going from a buy and hold bullshit pie chart portfolio or active trading that can make a decent rate of return, but you don't do this because you're afraid to pay the short-term capital gains tax, that makes no sense. Why not just get a better rate of return and then just pay the taxes and make more money long term? It's the same thing with options trading. Fees are part of the game. Iron condors are expensive, but don't ever change your strategy and change your risk factors just to save on fees. Only do it if it is literally in a vacuum exactly the same, then default to the cheaper fees. But don't trade wide strike gap because you don't like fees. Only trade it if there's a reason why you're trading wide strike gaps. Don't trade the indexes if you're just doing it for fees. Indexes don't have to deal with dividends. They're cash settled. They don't have to deal with early assignment, which is really never a problem, but technically it could. So if that's why you're trading the indexes, go for it. But don't trade the indexes because you're trying to save 1% in fees. It's just ridiculous. You're going to lose a lot more money long term. Again, I wish I had a really good explanation for why. I unfortunately don't. But yes, there you go. Strategy itself, always prioritize maximizing your rate of return and just pay your damn taxes and just pay your fees. Find a decent broker that you like with a good software to look at, and just put it out of your mind. Fees are part of the game. Now, I will obviously caveat this and say, if you're European, I feel bad for you because they absolutely rake you over the coals in those European brokers. It's the numbers that I have seen some of our VTS subscribers tell me that they're paying is exorbitant. It's criminal what you guys in Europe are paying. So everything that I've talked about doesn't really apply to you guys. Sometimes you guys really are paying $50 or $100 in trade fees. It's insane. If you're doing that, it's going to be a pretty difficult hurdle to clear. And at that point, you might actually just have to trade the ETFs and trade other strategies that they don't completely destroy you. But for anybody who's, American, Canadian, I don't know other countries, but yeah, fees are part of the game. Trade the best trade. Figure out fees, broker level. So hopefully that makes some sense, and we can kind of close the book on that for a little while. I don't mind talking about it and answering all questions, but I won't dedicate another segment to it. I think I've beaten the old trade fees to death. Yeah, let's get started. So, Wyoming Sprint Club. Awesome. Are you a runner? I dabble in the running. Which way should I lean? As you can see, these are not even close to the number of shoes that I have. I am a runner, and I do try every cool new shoe on the market. So hopefully I read that right. How's my eyes? Sprint Club? Yeah, I'm going to assume you're a runner. Okay. Read an article that said the VIX has lower volume now because people are using zero-day settlement. Might make some sense. That VIX can be manipulated, and that's why we got the spike in August. Will VIX become obsolete? Well, you've touched on a subject that is, even within the volatility space, debated. And it's one of those things where there really isn't a great answer. You'll get really smart people on both sides of the argument, whether the VIX is manipulated. Obviously, it could be. Whether it actually is or not, hard to tell because it's not an exact science. It could definitely backfire if anybody tried to do that. And they have made improvements over time to make sure that people aren't doing that. You can't flash order entries anymore. Like that was one of the things that was a big deal. Is the VIX manipulated? I don't know. My default position is I don't care, because at the end of the day, I do have to trade the market as it's presented to me. I can't, like, complaining doesn't do any good. Getting mad at the elites about manipulation doesn't do any good. Swearing that Goldman Sachs is running the market, and it just doesn't do any good. I have to trade anyway. So it is what it is. If it's manipulated, I'm going to have to figure out how to trade the manipulated VIX as best I can. And so did it cause the August stuff? No, probably not. But could it have? Sure, there's theory involved. And there are ways that you could say, yeah, if you had enough money on the institutional level and you kind of knew what you were doing and you could pin prices, and there are ways that you could say that. But it's something that you just can't really prove. Like maybe. I don't really talk about it too much. And the lawsuits that come out, they never really go anywhere when people sue these institutions. Even if it is happening, lawyers, fine print, they've covered their bases. You're never going to get any money out of them if they break the market. It's just broken, and it is what it is. So we just manage risk and do the best we can. Just trade the market as it actually is, not the one we want it to be. It's the best rule. So how does combining the individual vol metrics work? Not looking for anything proprietary. Can't give you any. Just curious if it's a weighted sum or a bunch of if-then rules. So in general, I have a weighting system. Not all 13 metrics are weighted equally. So that's one thing that I would say. I guess it's 14 because the VIX is in there at a 1% weighting. I suppose just a token little, the VIX is included. But the VIX is such a poor metric that it's not really included. I dive a little deeper into the actual option statistics, and I use that metric. I don't use the VIX as a whole. It doesn't measure what people think it measures. But it's just how much can I say without, because people do try to reverse engineer my work and sell it secondary to make money off my work. And I've actually even seen people send me emails that they're literally just subscribing and resending my emails to a community of their own and charging money for that. So I do have to be a little bit careful not helping them out too much. But weighting system, 13 metrics, 14 different values. I'll tell you if you are a VTS member and you wanted to start diving into these things, I will tell you that you should start with the information I've given about the cash VIX oscillator and the VX30 to VIX roll yield and the traders VRP. Those are the three that, while they're not huge weightings, those are the three that are weighted the heaviest. Or weighted the heaviest. Heavily weighted. My brain just broke. Everybody just witnessed. I just had an aneurysm on camera. I hope you get the point. They're weighted the most heavily. Come on, English. Okay, you got the point. But as far as how it's done with my percentile rankings and whatnot, I can't really go further. But you can email me and we can have a private conversation about that. Okay, when the curve is at backwardation and the VIX is much higher than the first month future, then does it make sense to buy a VIX put and short a VXX put for zero net cause? I think you're assuming that the VIX and the VXX are the same thing, and they are wildly different. They are not even close to the same product. So if you're trying to do anything involving a pairs trade with VIX options and volatility ETPs, or volatility ETPs and the market in general, or VIX options versus VXX options, these might as well be Apple and NVIDIA. Like they're correlated, obviously, but they're so different that they move so differently. I can show you that. People think that these are interchangeable. And I'm not saying you are. I might have just blazed through and read your question completely wrong, and now I'm embarrassing myself. But if you look at results-wise, here's the SPY. Of course, this year doing pretty well. Had a couple of dips, but overall going in the right direction. This is the SPY. But what about the SVIX? Shouldn't the SVIX, if the SPY is doing really well, shouldn't the SVIX also be doing well? Well, 37, it's at 25. It's down like 45% this year. Well, why is that? SVIX should be positively correlated very directly to the S&P 500, right? That's what people think. But no, volatility, the VIX futures And the S&P 500 options complex, which is what the VIX is based on, is a totally different market. And then even if you're thinking, okay, well, the VIX options settle to the VIX futures, so surely it's the same thing as the VXX. Again, it's not. They're different products. They're only converging to the same spot one time throughout the month, but the rest, it's crazy. So hopefully I read your question right. No, non-starter. I'm not saying you couldn't do one or the other, but if you're trying to do some type of pairs trade and arbitrage something, no, that is a no. They are not the same product and they will not track efficiently. Every time you do one of those, you'll be surprised by something. One time it'll go this way and this one was much better than that one. And then the other time it'll flip and the volatility ETPs are doing way better than the SPY. It's just super frustrating, and just consider them entirely separate markets. All right, the election has really contaminated the VIX. Yes, at least the curve, the shape of the curve. It's just not a great indicator of market sentiment at the moment. Can't wait for the event vol to pass. Yeah, I would say always, but right now it's a complete disaster. Like there's really no meaningful information that we can gather from this shape. You know, you want to see it's at minus 2% contango, backwardation. It was at minus 8% a couple of days ago. This is just, yeah, let's get past this and then everything might start to look a little normal. But yes, you're absolutely right. I would just take it slightly further than you did, and I would say that it's never a good indicator. But certainly now it's as bad as it gets. Compared to itself, it's even bad, which is saying a lot. Okay, the rationale is that the VIX will drop faster than the VXX when the curve goes back to contango. So you're adding a little bit to your pairs trade. So now you're saying that the reason is because the VIX will drop faster than the VXX. Why? It could be plenty of times where it's the opposite. Buy a VIX put and a short a VXX. No, it's going to be 50-50. Sometimes you'll win on one side, sometimes you'll lose on the same side. No, I don't like it. I don't mind you playing the volatility game. I just don't like you trying to somehow match these up and like this one's going to behave inverse to this one. No, it's not. What is your opinion on SVOL? It seems like every live stream I do it. Let me check what SVOL volume is. What's the AUM? It's like $1 billion, isn't it? It's an incredibly popular product, which is nuts because I just don't like it. I just don't. Net asset 1.26 billion. So good for them. Whoever the asset manager team here is at Simplify, I mean, good for them that they've got something that's so successful. I think it's a combination of the fact that number one, it's an extremely watered down product. So people might be under the false impression that they could actually maybe buy and hold it for some reason. But I guess they're not looking at it over a long-term time period about how bad it can get. Like it can really go down hard, just as, not as far as SVIX, but it can tank hard. So buy and hold is out. But the dividend aspect, I think, entices a lot of people who, for some reason, like dividends. And I don't want to get into a whole dividend rant. I do it seemingly every week. But essentially, dividends is a net zero transaction. You're not getting paid anything. It's coming directly out of the stock price. So you're basically just taking money out of this pocket, putting it in this pocket, and thinking that you made money. You didn't. You just have, like if you had $100,000 of SVOL stock and they pay the dividend, let's say it's a 1% dividend. I think it's significantly more, but let's just one. All that happens is you'll have $1,000 of cash and you'll have $99,000 of stock. I mean, nothing happened, right? You get a little bit of cash, you have a little bit less stock, and it's actually even worse because you have to it's a taxable event and you have to pay taxes on that gain. So it's like taking $1 out of this pocket, putting 70 cents back into this pocket and thinking you made money. It's weird how dividends confuse investors to thinking that they're actually making something. I think they're under the impression that this money is just added to their account without the exact inverse removal at the index level of the stock price. They kind of forget that part. But, when you point out, you can see it clearly on a special dividend, right? A massive special dividend. You can see the stock price just absolutely tank. But I think what's happening is people can't see it because dividends are paid quarterly. And it's usually a very small amount. Like say you're talking about Coca-Cola, it's a 40-cent dividend. You're not even going to see that in the stock price. So people think like, oh my God, they paid me a 40-cent dividend. I'm better off today than I was yesterday. But they can't see the stock drop actually went down 40 cents as well. But in a special dividend, you can see it. It's just going to absolutely gap down. So you get this influx of cash in your account and you get a removal of equity from your account. Well, who cares? Like, why would I want that? Why wouldn't I want to just own a good stock or have a good strategy that makes the most money and I'll decide when I sell the thing? Like, I don't want somebody else telling me, okay, you pay taxes today whether you want to or not, and your equity is removed from the stock. So I did it again. I just feel like I just have to die on this hill that dividends, it's one of those things that if you love the stock and it happens to pay a dividend, great. I have no issue with that. But don't ever buy something because it pays a dividend, because the dividend is a net zero transaction. It literally comes out of the book value of the company. It's not free money. It didn't poof out of, thin air. It came right out of the company's book value. So it's like trade fees. Don't ever adjust your strategy to save money on trade fees. Don't ever adjust your portfolio to save money on taxes. Don't ever buy a stock because it pays dividends. Only do those things if you were going to do it anyway and it's an in-vacuum net zero thing that, yeah, this is better than that, then go ahead and do it. But don't buy SVOL because you think it either can buy and hold, which it can't. I will make a video about SVOL. It does go down a lot, can't buy and hold, and the dividends are meaningless. So only use SVOL if you have some third reason for doing it. And I'm not telling you can't use the product. Maybe it serves a purpose. It's actually about 0.25 or 0.3% leveraged. So it's even maybe half of SVXY. SVXY is already half of SVIX. SVOL is about half or 2/3 of SVXY. So if you like it for the reason that it's incredibly watered down and you have built-in risk management, great. I have no problem with that. Use SVOL. It's a tame product. If you're entry level and you don't manage risk well, use SVOL for sure. You'll lose less money. Just don't do it for the dividend and don't do it because you think it's a viable buy and hold. It is neither of those things. So now I'm going to get killed in the comments again. No, you don't understand. Dividends are, they're paying you to own the stock. Yeah, at the expense of my already existing equity of the stock, sure. Given how predictable the decay of VXX is, who is on the other side of the trade when you sell your shares of SVXY? Won't the buyer of your shares know their value is going down? You make sure I follow here. Given how predictable the decay of VXX is, who is on the other side of the trade when you sell your shares of SVXY? Well, there's speculators and there's hedgers. There's people who are profiting off short-term trends, and there are people who are profiting off long-term trends. So short-term people might really like VXX because they're trying to hedge a portfolio, or they're making a short-term play that maybe the market is at a peak and it's going to get weak. And there are other people who do longer-term plays that we know that over time, of course, they do decay downward. It's all kinds of different things. It's like all of these volatility ETPs are insurance products, essentially. They're structured that way, that if you're buying them on the long side, you are just paying a premium and dragging it down. In long term, it will absolutely go negative for sure because it's an insurance product. But it hits every now and then. That's what insurance does. Fire insurance on your house plotted on a curve would look exactly the same as VXX. That's what it would look like. Car insurance, we pay it our whole life. I mean, does it ever really hit? Maybe, maybe not. I mean, knock wood, you don't want that to happen, but that's what insurance does. So you can make money on both sides of the insurance game. You can make money on both sides of the volatility game. There's different people with different goals doing different things with the products. All that matters is you know what you're doing when you buy your product, right? Even I might disagree with what you're doing because maybe it doesn't mesh with my strategy. But I'm not going to tell you that you're wrong because I don't know your strategy. Maybe what you're doing, like maybe you're one of these people that buy the volatility products. I would recommend against that because, like you said, they do tend to go down pretty consistently. But you might know what you're doing. I don't know. And so I wouldn't necessarily just outright say this is the right side of the trade to be on, because it totally depends on your time frame, it depends on your strategy, depends on your portfolio allocation. Heck, maybe people are buying VXX simply because they're gaming the system, like getting back to the manipulation. What if there's somebody out there that they could set up some system where they're actually buying the VXX in some type of account, and then they're also shorting it somewhere else. They're loaning out their shares and they're making premiums off that, and they're structuring the whole thing. So on their perspective, it's a net zero, but technically they're long the VXX or the UVXY, and maybe the fees that they're getting from, lending out shares, maybe that covers the constant bleed. Could be all kinds of things is my point. I don't know why people are all using these products. You'd have to be in the room with them. But I trust that they think they know what they're doing. Most traders lose money, so they're wrong. Most traders are wrong. You're actually doing it wrong. But everybody thinks they're doing it right. So there is no way to say, hey, it does this. What kind of idiot would ever buy the inverse of that? Well, an idiot who thinks they have a strategy, an idiot who makes more money on the fees than they bleed in the premiums, an idiot who, fill in the gaps, they want to hedge their portfolio, and their net long stock portfolio makes way more money than the cost of the VXX. It could be any number of things. I wouldn't look down on the people on the inverse of your trade. They think they're better than you as well. So they're probably asking the same question. Well, who in their right mind would be on the other side of my trade? I know what I'm doing. Who's taking the inverse of me, right? We all think that. But they have a plan. You said that you need 5 years of data before Barometer produce signals. Does it mean you use a rolling window of 5 years for all volatility indicators to calculate the percentiles? Essentially, yes. I don't want to give out too much information, but essentially, yes. You have to wait a while. Like if you go on day one, what is a 90th percentile reading on day 5 of a metric? Nothing. It could be the 5th lowest day on volatility in the history of volatility, but in your system, it's reading a 90th percentile, like extreme vol level. But wait 5 years, and that 90th percentile might turn out to be, oh no, that was just a 3rd percentile. You needed more time. So I don't use any signals. Well, it doesn't matter now because it's live trading since 2008-ish. But certainly when I started, I knew enough to know not to use it too soon, is essentially what I'm saying. All right, TastyWorks has extreme low fee. I have heard that. I don't know. I've never tried it. This will solve the problem. Again, if you want to save trade fees because you're switching from TOS to TastyWorks, go for it. If you like what TastyWorks looks like, that's a fine solution to your problem. If you have an emotional starch blocker of paying too much money in fees, then certainly get a list of the 5 biggest, most trustworthy brokers with the best customer service. They have live chat if you run into troubles. They give you really good tax forms all prepared for you. Get the 4 or 5 best brokers and then pick the one with the best fees. Now, like I said, for me personally, because I'm on my computer so much, I just can't stress enough how much I like TOS. It is, even if TOS doubled their fees, which I hope obviously they don't do, I would still use it. It's intuitive, it's user-friendly, it's beautiful to look at. I just like it best. But I've heard very good things about TastyWorks. So back at the time when I wanted to try it, I wanted to dump some money and try it. At the time, I use international accounts. I'm Canadian, but I use US dollars in US denominated American accounts. I wasn't allowed to open TastyWorks. So I've never tried it. I've never seen it. But I will say I've never heard a bad word about it. And not overly surprising. It's designed by the same team as designed TOS. So I'm sure it probably looks quite similar, to be honest. It's Sosnoff and the boys. I think they basically took everything they learned from TOS and went and made their own somewhere else. So it's probably very, very good. I wonder if it's the dividend and row difference that causes the index to underperform. It could be. You got to also understand that the index settles on a different day, so it's not technically the same trade either. That should balance 50-50 though. I mean, there would be no reason why that would change it. I've just chalked it up to I've ran the numbers for 5 years. It's actually probably 6 years. For whatever reason, there was about a 3 to 4% drag. Don't know why. SPX was the best performer. I think it was like a 2% drag. And that could simply be because if you look at these indexes, let's say if we look at SPX, what you'll notice is, did I click screen share? Yes, I did. What you'll notice if you do the SPX is that, let's find one of these, 62 December. You'll notice that we do the 15 delta options. Delta is this row right here. You can see around the 15 delta, you can still, even on the index itself, you can get pretty tight numbers. Now, obviously, you'd want to go on the zeros. You'd want to go with the larger open interest ones. But you can design, trades pretty tight. So you don't have to have super wide wings. But if you go to the NDX, for example, I mean, this could, it simply could be that it's just a massively inefficient thing to trade. But if you go to the 15 delta on the put side, you can see these are $25 strike gaps, and that's the closest it gets. But probably more interesting, this is going to be at least 50, maybe even 100. Here's the 15 delta, and we've got $100 gaps on the call side. All right, so you've got 21,800, 21,900, 2,200. That's not very efficient. Now, the RUT is probably better than the NDX, but just in my own personal trading, I found the SPX to be reasonably okay. And then the NDX and the RUT were not great. There was definitely a significant drag there. Wish I had a good answer. I really do. This info alone, index options perform worse than ETF options, makes this video worthy. Did I earn the like on the video? One person or several people? Hopefully several. Thank you for the support. Hit the like button. Hopefully I'm helping somebody. Which video was the one about taxes? Can you show which one it was again? I did a 2-part series showing, 2-part series. The first one I showed, this one's called Active Trading in an IRA Account. VTS is tax deferred. This is something that a lot of people, maybe knee-jerk reaction. They think because I'm more of an active tactical rotation trader, that somehow it's very tax inefficient. But the thing you have to know is that my entire portfolio can be traded within an IRA. So it is entirely tax efficient. It's literally exactly the same as any other buy and hold portfolio. The only difference would be if you get to the point where you have exhausted your limits on those tax deferred accounts, then at that point you have to have capital outside of the tax deferred accounts. So let's say I don't even know in the US, but Canada, let's say it's like, $20,000, $30,000 you can get in the tax deferred sheltered accounts every year between your TSFA and your RRA. In the US, I don't know what it is, to be honest. But let's say you save 50 or 100 grand a year and you're not allowed to stuff 100 grand into a tax deferred account. Well, at that point, you'd go on to video 2 and I break down the differences between a person that's entirely tax efficient, a person who adds $1,000 a month of actual cash to a cash taxable account, and then somebody who's maybe quite wealthy and maybe adds 5,000 or more. So I covered all 3 of those in this. So these are the 2 back to back. Watch this one if you're interested. For some reason, nobody is. 784 views. Give me a couple more. That was a good video. Maybe it was the echo in the room. And then this one is really the one you want because the punchline, I don't want to spoil it too much because I want people to go watch it, but the general punchline is it's about 1% if you save 1,000 extra per month, then your tax deferred accounts can handle. So you are actually adding $1,000 a month to an account that would be charged short-term capital gains. You need to make 1% extra per year in rate of return. If you're adding more than that, let's say you have a really good income and you save a lot of money, you probably need about 2% extra to cover that capital gains drag on your portfolio. So I'm not going to say that, past results and all those disclaimers about, not indicative of future results and all that. But with VTS, our portfolio returning 22% a year in the last 13 years, compared to the buy and hold portfolio bubble pie chart stupid things that financial advisors do at 8 during a bull market, probably 6 or 7 during a long term. Yeah, the 2% bar is easily cleared by having better strategies. So would I ever be concerned about trading my active strategies that, this one has made a really good return. The defensive rotations made like 35% a year. Would I ever give that up simply because it's not tax efficient? No, that would be insane. Why wouldn't you, of course, just chase the best rate of return and just pay the taxes? It's fine. Or just join me and move to Dubai, and then we're all good, right? Who wants to pay taxes? I'm not giving my money to Justin Trudeau and his cronies. No way. So there you go. Sprinter, no running. Same thing. Sprinting's totally different. I get it. Sprint, I'm not great. I'm a distance guy. So, and even that, I used to be a competitive swimmer. I actually competed at a national level in swimming. Won a bronze medal at nationals once. And my race was 1,500 free. So if anybody's a swimmer in the chat, that's the longest distance race that there is in men's swimming, the 1,500. And that was my race. Or the 400 IM was also my second best one. So individual medleys when you swim all four strokes, and the 400 is the longest one that men compete in. And so 1,500 free, 400 IM were my two. 50 free, 100 free. I was never a relay guy. I'm not a sprinter. But when I run, I'm a marathoner. I'm not a sprinter. So I can just set my number and I can just I can run for 4 hours, just the same speed, just listen to podcast or listen to music. That's my speed. Sprinting, I would imagine you would leave me in the dust pretty easily. I think my 5K, my best 5K is I ran one maybe a month and a half ago to test my speed. I ran it in 1851, I think is my best one. I'll have to check my spreadsheet. I spreadsheet everything, but yeah, I'm not impressively speedy. I'm more of a marathoner. All right. VXX stays, what time is it? Hour 6. Let's wrap this up soon. VXX stays elevated, then I can collect a higher premium than with a broken wing butterfly. I feel like I've missed something. Let me look for your name. I think I'm catching you in the middle of a comment here. Unfortunately, I don't see anything from you other than that comment, standalone. Just out of the gates, confused. VXX stays elevated, then I can collect a higher premium. I wouldn't be in broken wing butterflies right now either. I don't trade them during elevated volatility. I trade broken wing butterflies during mid to low vol. That's when they perform best. You briefly touched on SVIX. Can you elaborate more on difference between SVIX and SVXY as they both track first 2 months of VIX future? They do. They are what you would say structurally, I can't say identical, but structurally extremely similar, we will say. They both track the front 2 months of the VIX futures, and the only difference being that the SVXY is a minus 0.5 times leverage factor on a daily basis. And remember, that happened after Volpocalypse. So Volpocalypse is February 5th, 2018. The whole market, VIX went up 115%. XIV, the old XIV, went past its, clause and it was terminated. SVXY did not terminate that day. It was also down 96% that day, but they did not scuttle the product. They kept going. And then on February 27th, I believe, they reduced the leverage factor from -1 to -0.5. So now for the last, 6 years, it's -0.5. And that trades based on the standard SPVIX STR index, basically. It has its own, so it's actually not this one. It's actually, if you want to be specific, it's the MP5I, but these are just, silly ticker numbers. The SP5I is what the SVXY goes. And the only reason I can't say they're structurally identical is because the SVIX has its own underlying index called short vol. And the short vol index is specifically being used by only 2 of the products. It's being used by SVIX on the inverse side, and UVIX, the 2 times long, uses the long vol index. But structurally identical-ish, right? Those 2 indexes have slightly different rules. The trade at settlement rules, the window of rebalancing is slightly different. The bid-ask spreads might be a little bit different. But let's just say they both function very well these days. This isn't the 2018 days. They've fixed it all up, and they're both just fine. So yeah, SVXY half of SVIX. Everything else on a day-to-day basis, one day only, because they're one day rebalanced. If you look at SVXY and SVIX over 6 months, it's not going to be literally half. It doesn't work that way. But on a day-to-day basis, it is half the movement. And it sticks to that. They both function really well. So built-in risk management for using SVXY, if you're curious, I like it as well. Within our tactical volatility strategy, I use SVXY myself. I think it's great. You might think, oh, it's watered down. It's a little watered down. The SVIX works fine as well. I'm not scared to trade it. It's just that SVXY does provide that built-in risk management. You got to remember that vol spikes come out of nowhere. Flash crash comes out of nowhere. A cyber attack is coming at some point in the future. Hopefully it doesn't hurt our portfolios too badly, but the world is that situation. We got to expect these things. I just think that it's probably best practices. You should reduce the exposure on things a little bit. And if you take half the return and half the drawdowns, you actually make more money long term. So maybe this is a good topic for next week. Where's your question? I will just show the SVIX plugged straight into my tactical volatility strategy, and I'll show you that the return is not double and the drawdowns are not double. It's actually, there's an inefficiency there because SVIX is too much leverage. And so, yes, the return gets much better, but the drawdowns get even more worse, and drawdowns hurt your portfolio more than gains help, right? It's the old, you make 10%, you lose 10%, you're not back to break even. You make 50%, you lose 50%, you think, oh, that's, it's a wash, right? No, it's not. You're down 25%. That's what's the problem with using SVIX, is that it's a little bit too ramped up, and those bad days are just going to come out of nowhere, and they're going to cost you, and it's going to drag down the performance. So I like using SVXY, but I personally would not go down to the SVOL level. I think that's getting a little bit, too watered down, a little bit unnecessary at that point. I think that, my tactical vol strategy makes about 30% a year. With SVXY, it would make about 47, 48, I'm guessing. With SVIX, it'd probably make about 18 to 20 with SVOL, but the drawdowns would be lower as well. So some people might value that. I'm not going to say you're wrong. It just doesn't fit in with my strategy. And SVIX, some people might say, hey, I don't mind if it's 50% drawdown. I just want more profit. Okay, switch them out. Every time I give the SVXY green light, just use SVIX if you want. I personally don't, but, that's what I would say. Don't automatically assume that SVXY is some useless, watered-down product. It's actually really good. I love the risk-reward ratio of SVXY personally. All right, should I try to get these last two? About stock replacement strategy using VXX, it's 2:15 in the morning for me. So actually, it just occurred to me, my wife isn't home from her party yet, so I'm getting a little bit nervous. About stock replacement strategy using VXX, you pointed out that one should avoid buying puts during periods of high volatility so as to avoid large vega. Do you have an ideal volatility buying range? Well, the typical range that I always say is about 65% of all readings, ranked percentile. Anything below that, you can start to short volatility, and you can be reasonably okay buying vega at that point. Yes, if it goes from 65 to 30, you'll get hurt by that vega because you're technically buying into, if you're doing stock replacement. Remember, I do give the instructions for stock replacement every day in that strategy. If volatility did go from 65 to 30, it doesn't this doesn't go to zero, just for people's interest's sake. 20 is extreme low. It hasn't been 20 in years. It goes to about 30. Yes, you will be buying into a vega headwind if you do that when we go here at SVXY on day one. But you got to remember that stock replacement has several advantages that the ETF does not. And so on balance of everything, this cancels this, and in the end, it's basically the same. But you would never want to go long vega above about 65 or 70% vol, because that's just too much of a headwind. Buying a long call option when volatility's in the extreme, you wouldn't do stock replacement that way. You would do a vertical spread, because a vertical involves both a put and a call, so dramatically reduces that vega, and then you would just do verticals. And yeah, you can't get the super explosive growth on a vertical compared to a straight up call, but it's plenty good enough to do the job. It's basically a tail risk hedge, and it works really well. So that's what you would do. You don't buy super high vega in high vol. Did a video recently about that as well. I'm sure you saw it, but yeah, about 65-ish, 60-ish, you're safe, right? The amount of bleed is more than made up for by the fact that stock replacement is less risky because you can only lose the money you put up, and they're very capital efficient. So if there's a flash crash and the stock market blinks out of existence, the stock replacement trade will only lose about 25%, whereas the underlying ETF, if it blanks to zero, it loses 100%. There's that. There's the efficiency. You can adjust the delta factor. There's a lot of things that you can. Stock replacement has some advantages that offset the vega headwind. Okay. I am a subscriber. Wait. Sorry, Liberty. He just popped in with another follow-up question. Oh, no. I'll get to that later. No, here we go. Can I ask what barometer cutoff value is for entering SVXY, SPY, QLD, not QID? I would like to use the cutoff values, but I would use sector ETFs over SPY and QLD. So there's a couple things here. First of all, you don't need the cutoff if you're a subscriber. This value isn't technically the same value as the barometer. Each of the three strategies uses a slightly different weighting system of the metrics that are in the barometer. Because of course you want to maximize diversification in a strategy, and I wouldn't use the exact same volatility metrics for three different strategies. I have slightly different variations with a little bit different weighting for all three. Now you can see it's close enough, but there are times when it deviates quite a bit. So it matters that I should point that out. It's not the same number. But that doesn't matter for you as a subscriber. You just get the signal. So if I go to SVXY, you're saying that you want to replace that with something a little more specific. Instead of the SPY, are you saying that instead of the SPY, you're going to line up the 10 sector rotation ETFs and you're going to choose like healthcare, or you're going to choose the one that you think is going to perform the best? Some people like to do that with individual stocks. Like instead of the SPY, I'm going to buy Apple, for example. At that point, you'd be going rogue against my signals. So I cannot say that I've tracked the numbers or the performance. I have not. And also, I can't be held too responsible if you were going to take the signals and do something else. But obviously, it's your money. If you want to take the general ranges like I do, when we're in aggressive positions, if aggressive to you means I'm going to buy Microsoft instead of the NASDAQ, cool. You do you. But for me personally, there's indexes are safest. That's why you see we only trade indexes and volatility ETFs and options. We do not trade individual stocks. We don't narrow it down and try to say that, I think the energy sector is going to outperform the financials, so we're going to do like a pairs trade against that. We don't do any of that stuff. Indexes are just fine for investing. But if you want to go rogue, you go right ahead. Anytime SVXY, pick your poison. I gather you're a risky investor, so you could go with SVIX. Instead of SPY, you'd go with something else. Try not to have it like too radical a stock, because sometimes they can crash really hard. And QLD is already 2 times leverage. I mean, defensive rotation has made, like 30, 40%. I don't even know the number, probably closer to 40% in the last 5 years. If that's not enough for you, I don't know what to tell you. I'm pretty happy with those results myself. But you do you. People go rogue. They take my structure as a baseline and then they try to improve on it. And if you can do that, then you go right ahead. There you go. Follow up. I want exposure to NVIDIA. Good luck to you. Obviously, if you could get in a time machine and you could have done this 5 years ago, you'd have been very happy. Starting today, going forward with NVIDIA, I don't know. I'd say it's out of my wheelhouse. I don't analyze individual stocks that much. I pay attention. I mean, I see trends, but I'm not the guy to ask if you want to know if NVIDIA is going to continue its incredible run. I'd just throw my hands up and say, I have no idea. All right, follow-up question. Would SVIX get wiped out if the VIX spikes by 100% in a single day, similar to what happened during the Volmageddon event? Well, first of all, the SVIX trades based on VIX futures, which have a beta to the VIX itself of about 0.46. So if the VIX spikes 100%, it's different every day. This is not a mathematical mirror or anything, but a long-term beta of 0.46. So if the VIX spikes 100%, we would expect the VIX futures and that VX30 combination, contract would spike 46%. And in that case, the SVIX would lose 46% of its value. So technically speaking, if everything tracked the long-term beta factor on that day of the spike, and it can deviate wildly, I'll just say. Like sometimes the VIX futures are super muted compared to the VIX, and sometimes they way overreact compared to the VIX. So this is not a consistent thing. But let's just say it follows the 0.46 beta. You would need the VIX to spike 200% to wipe out the SVIX. The only reason the XIV and the SVXY went down 96% when the VIX only spiked 115 is because the underlying indexes broke. There's nothing wrong with the XIV that day. It performed exactly as it was supposed to. The underlying VIX futures saw a complete break because $5 billion of money tried to go into the VIX futures at the end of day rebalancing, and it totally shocked the system. But if you do a back test on the short vol index on February 5th, 2018, I believe, you want to do it with me? I believe it was only down like 30-ish, something percent. Let's go. So where's February 5th, 2018? Let's go see what the short vol index did on that day. So here's February 5th. And let's go find its underlying index. You can see the SPVIX STR went from 56 to 110. This index broke, and the XIV is trading based on these indexes. So it totally broke. But look at the short vol index. It went from 2160 to 1500. At the time, the short vol index didn't exist, and no volatility ETPs were trading using the short vol index. So this backtest is just how VIX futures were supposed to behave in a normal, smooth market. What they didn't account for is that there's $5 billion. At that time, the short vol trade was on fire. The assets under management of the volatility space started to dwarf the VIX futures that they're actually trading on. So it was just an insane amount of volume going into the VIX futures that the tail wagging the dog, the actual ETF that the futures are based on was bigger than the futures it was based on. So it actually just blew the whole system out and XIV crashed. But I mean, what is this? It's not that bad, right? It's 30%. Yeah, like I said, it went down. It should have been 30%. So essentially, my whole point of saying this is the VIX is not the VIX futures. All volatility ETPs trade based on a constant 30-day rolling maturity contract called the VX30, and that has a low beta factor to the VIX itself. So SVIX would probably need, on balance of probability, a 200% spike in a well-behaving market to blink it. Now, it's never happened. 115.6% is the highest the VIX has ever done. But if you go back to 1987 and use the old VXO, it went to 172, so all bets are off. Black Monday 1987 would have wiped out every single volatility ETP on the market if they had existed. So I'm not saying it couldn't happen, but it would require about 200% for the VIX based on long-term averages. And that would mean SVXY would require about 400%. So they are safe-ish. And now the volatility complex is a shell of its former self. So it's not dangerous. The end-of-day rebalancing is not an issue anymore. Plus, SVIX and UVIX don't even use the SPVIX STR anymore either, so they use their own indexes. It's all totally functioning smoothly now. So we would expect a vol-apocalypse. Certainly now it's not on the cards. Can't say in the future. If if conditions change and the volatility space rises again and the VIX futures are way smaller than the volatility ETPs, I'll come onto a live stream and tell everybody, please deleverage down. Please use SVXY. Maybe then I'll recommend SVOL. I don't know. Pretty watered down. Maybe it'll be the one. But right now, there's no risk of that. Hopefully that all made some sense. It's weird because all of these are volatility stuff, right? But they're not the same product. These are all different underlines, like VIX, VIX futures, SPX options, like the VIX options. All of these things are correlated, but entirely different markets. So you have to understand the interworkings of all of this. You know, that would actually be another solid live stream. Thanks for the recommendation. Okay. Oh, here we go. I was totally wrong. You don't want to buy NVIDIA. You want to avoid NVIDIA. Okay, now you're talking my game. I don't know if NVIDIA is overpriced or a terrible buy. I would just personally be very nervous with something that's done so well. There's no reason to think that way, right? That's irrational. Even for me, a very quant-specific person, even I get a little bit emotional about certain things sometimes. And buying something that's on an incredible run just seems like a bad idea to me. So I'm with you, even though I'm not saying that NVIDIA is going to crash. I don't know. Maybe it's going to triple in the next year. Who knows? But I would be extremely nervous being too exposed to NVIDIA. I'd rather just hold the index. Yeah, it's a large part of these indexes, but in the grand scheme of things, it's still an index. So all good. Hour 25, I suck at capping at an hour. Every single live stream, I try to do 1 hour. So hit the like button on your way out the door. I've got 2 solid recommendations for future live streams. Thanks for the interactions, the comments. Don't hate me if you're a dividend investor. We can still be friends, and we'll see you next week.